the CPF is ranked as a top retirement pension system in Asia, as it can give us a steady PP income during our retirement years. However, the downside of CPF is that it's sometimes a bit complicated and not everyone may understand how it works. Even I also don't fully understand it. That's why in this video, I'll be sharing the top 7 things that you may not know about CPF so that you can better understand it and maximize it for your retirement planning. Before I start, do join my Telegram group to discuss anything related to money or ask any questions that you may have. Alright, let's jump right in. First, did you know that CPF interest rates are not fixed? So right now, we are earning 2.5% on our ordinary account balance and 4.08% on our special accounts, Medisave accounts and retirement accounts, right? These rates are not fixed and instead are reviewed quarterly. The interest rate for OA is the higher of the 2.5% floor or the 3-month average of major local banks' interest rates. So, for example, for the previous quarter, the average bank interest rate was 0.6633%. That's why the floor of 2.5% is used. As for SA, MA, and RA, the interest rate is the higher of the 4% floor or the 12-month average yield of the 10-year SGS plus 1%. And because the 10-year SGS yield has been going up, the interest rate for the upcoming quarter has also gone up to 4.08%. What? Besides that, for SA, MA, and RA, the 4% floor is also reviewed annually. So even though right now it is at 4%, in the future it can either go up or go down. Next, did you know that CPF pays an extra 1 to 2% interest on our first 60k of our CPF balances? If you are below 55 years old, you can enjoy an extra interest of 1%, whereas for those 55 years old and above, there's an extra 2% interest on their first 30k and a 1% extra interest on the next 30k. However, only up to 20k in our OA will enjoy this extra interest. This cap of 20k is there because according to CPF, OA savings are short-term in nature and can be withdrawn anytime for a few purposes such as housing and education. So if you are a young adult who just started working, it is likely that you have less than 60k in your CPF account unless your daddy is a rich man and has been topping up your CPF since you were young. If you have less than 60k in your CPF, you can consider topping up to your CPF SA or MA to fully benefit from the extra 1% interest while enjoying a tax relief of up to 8k per year. Also, fun fact, this extra interest earned on your OA balance doesn't stay in OA. Instead, it goes into your SA or RA, which means that you get to enjoy the higher interest of 4%. So that's nice. Next, as you may already know, our CPF OA money can be used for our house down payment and money installment, right? However, what you may not know is that when we sell our flat, we will need to pay back what we took from our CPF plus any accrued interest. What? This is because the accrued interest is the interest that you will have earned in your CPF accounts if you have not utilized the money for the purchase of your flat. Or in other words, because you borrowed money from your future self, so you need to pay back the money lor. So let's say if you had used up 150k from your CPF for the down payment and stamp duty and $1,200 per month to pay off your flat over a period of 30 years, you would have ended up using a total of $959,743 from CPF, out of which $377,743 is due to accrued interest. This means that when you sell your flat, all this money needs to be returned back to your CPF. Similarly, if you have taken any housing grant, this grant will also have to be returned to your CPF along with any interest accrued.
Wow, take back so much money? Like that, no more money, you know?
Okay, this is actually not a big problem because the money that's returned back to our CPF is still our money, yeah. This will be used to secure our retirement, plus we will also be using the CPF funds to purchase our next home, right? But if you are concerned about the accrued interest, you can do a voluntary housing refund, which allows you to return what you use from your CPF for your housing. By doing so, you will refund less accrued interest in the future while receiving more cash proceeds when you sell off your property. Though, if you happen to sell your house at a loss, you do not need to top up the CPF shortfall if the selling price, including the option monies, is insufficient to refund the amount used with accrued interest after paying the outstanding loan. This is provided the property is sold at market value. Quick pause, did you know that besides Weeboo's awesome sign-up rewards, Weeboo also provides you with some pretty useful features to do stock research? To find that, you can open up your stock page, then at the top right, if you tap on the tiny down arrow, you will see some useful info of the stock, such as the price to earnings ratio, price to book, price to sales, the 52-week high, 52-week low, and current dividend yield. They even show you what's the next earnings date. Definitely useful for staying up to date with the stock. Then if you head over to the company tab, you'll find a lot more info about the stock. For example, you will get a financial brief for the latest quarter. Some key indicators can also be found, such as return on assets, return on equity, net margin, and so on. Aside from those, you can also find some quick summaries of the financial statements, such as income statement, balance sheet, and cash flow. There's even a peer comparison feature where you can compare the company with its peers, all of which are definitely useful when doing stock research. Also, if you sign up using my link down below, fund any amount while also subscribing at least $500 into Moneyboo and keep the money there for 30 days, you will win 25 free shares worth anywhere between $3 to $500 each. Besides that, there's also a Moneyboo promotion where you can earn up to $3,000 by funding more and fulfilling the requirements. Weeboo also launched a new transfer promo, from which you could possibly get up to $2,000 worth of free shares or more by fulfilling the requirements. So if you are interested in trying out Weeboo, do sign up to them using my link down below. With that being said, let's get back to the video. Next, as you may already know, when we turn 55, the savings from our SA followed by OA will automatically be transferred to a newly created retirement account. The amount that will be transferred is up to the full retirement sum, which is $198,800 in 2023 and $205,800 in 2024. So that's a lot of money, yeah? This means there's a chance that all your CPF OA money could be transferred over to RA. Then you will have no more money in your OA to pay for your property law. Don't worry, because it's possible to reserve your OA money to make sure there's still some money in there. To do that, you can log in to my CPF online services, head to my request, select retirement, then select decide on my CPF options for members reaching 55. Next, did you know that it's actually possible to withdraw money from your retirement account? If you turn 65 from 2023 onwards, you can withdraw up to 20% of your RA savings in a lump sum. This amount includes the first 5K that you withdrew from your OA or SA at age 55. Not only that, when you turn 55, you can also withdraw any amount in excess of the FRS from your OA and SA savings. Or if you own a property that can last you up to age 95, you can withdraw any amount in excess of the BRS from your RA savings. However, just because you can withdraw the money does not mean that you should do it, yeah? If you choose not to withdraw, you can continue leaving it in your RA to earn the attractive interest of 4 to even 6%, and with the magic of compounding, you will get higher monthly payouts on CPF Life. Next, there was this letter that went viral back in 2019 because many people thought that CPF still wanted to lock up our money some more even after our retirement. But that's not the case, because by default, CPF Life only starts giving monthly payouts when you reach 70. But if you want to receive the payouts earlier, you can apply to start receiving these payouts at age 65. Though, if you don't need the payouts, it's still best to defer the payouts till you turn 70, since you get to receive up to 7% more for each year you defer your payouts. Fun fact, even if you have already started receiving your CPF Life payouts, you can still apply to defer the payouts to 70 years old. Also, did you know that your CPF Life payouts are not fixed?
What?
CPF Life payouts can actually go up or down depending on the interest rate and mortality rates. For example, higher interest rates mean higher CPF Life payouts, as higher interest rates allow you to earn and compound your RA savings. And if there's a higher mortality rate and more people live longer than expected in the long term, your monthly CPF Life payouts might be lower to ensure that CPF payouts are sustainable for everyone over the long term. But don't worry, because even if there's a change, the changes are expected to be small and gradual, and the changes will only happen on an annual basis. So these are the 7 things that you may not know about CPF. But what other little known facts about CPF do you know of? Do comment down below and let me know. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.